All right. Good evening, everyone. Welcome to whatever we have today. So we're talking about the components of markets mechanics. Now, which is the complex mechanics. So, as a course of our last class, we discussed about the basics in which we talked about market mechanics based on the concepts of supply and demand. I'm also talking about market mechanics based on smart money concepts. Now, in the smart money concept, we made to understand that it is a kind of concept that, like, more or less, it explains the market mechanics by telling us that, okay, there are some levels at which institutional traders who regard as those smart money guys, those big banks and all that, they have certain levels in the market that usually enter the market from. All right. So now, following that concept, we most likely want to trade alongside with the smart money guys. We want to enter the market when they want to do what? When they want to enter the market at their points of entry, that's where we most likely want to enter the market from. All right. And that's why we are regarded as the smart money SMC traders, because we follow the smart money guys in doing what? In taking trade. All right. Now, with that being said, there are some levels at which the smart money guys usually enters the market, and these levels these based on liquidity. The smart money guys own that liquidity and all that, but we'll just be talking about those levels for now, leaving liquidity for later. So now, how do we determine those levels that your smart money guys usually enter the market? All right. Now, this SMC is more or less a concept that came on board after some traders studied the smart money guys. All right. And after studying the smart money guys, they figured out that there are some certain levels in the market that smart money guys will most likely enter, like the market. All right. Where they usually place their position, their trades and all that. There are certain levels in the market that those your smart money guys are actually interested in. So now we made our research and we're able to find out that at such levels, so and so are being present there. There are some things in particular that are present at such levels. And because of all those things that are present at such levels, that's why we smart money guys, smart money traders, SMC traders, we use those things, those tools in doing what? In taking our trade. Some of all these places, all these levels include your order blocks, your breaker blocks, your fair value gap, your rejection blocks. They are there are more than that though. They are more than that. We have the QM arrow and many more others. All right, but based on the study from those smart money guys, we are made to understand that all these levels are like the places that we most likely see your smart money guys stationed. Now, one thing you need to notice that smart money guys are not stationed at such level because it is an order block or a rejection block. No, all right, they don't even know it be other block or rejection block, only concern them with all those ones. So don't think that they're stationed there because of your other block or your rejection block. All right, that's the first thing you need to understand. We just try to track the smart money guys based on whatever we see on the chart. They might not even be using the chart that we're using, they might not even be using it. So I don't know how you want it to say they go, they follow it, they use your other block. No, it's just because that where they most likely use in the charts, such levels, we most likely tend to see the other blocks, breaker blocks, fair value gap, and rejection blocks in such levels. All right. So with that being said, we start up with our components of market mechanics. All right, which will be those levels that the smart money guys usually enters the market. And with that being said, we'll be taking our trade on those levels in particular. All right. So I went over to my trading view now and try to explain it based on the concept of premium and discounts. Think I've already used this concept before. For those of you that remember, when we're dealing with market structure, we talk about the concept of premium and discounts. Well, these are concepts that you most likely come across over and over again in the market. Let me see. Let's go with Altcoin USDT. Price not reached that side. Almost forgot that I have some leftover this thing here. So now let's talk about those levels. First of all, let's draw out our premium and discounts. Remember, when we're dealing with this thing, we said that the upper side is regarded as the premium zone and the lower side is regarded as the what? As the discount zone. If you don't remember, go back to that video based on a basic market structure. You see the premium and discount. So with that said, let's move onward. Now, these levels that you most likely see your smart money guys position is being like we kind of group them based on how they appear in the charts. And the one at the extreme end, all right, now this is the PD array. All right, what I'm about to draw for you guys is the PD array. All this stuff have been arranged in the premium and discount zone. So the first one being the rejection block, like the one at the most extreme parts of the chart, that is the rejection block. Sorry for the rough drawing up. We don't have much time yet. That's why I'm trying to be quick. Suppose you prepare this thing beforehand. All right, so now remember that this middle line here is the equilibrium, and whatever is above it is the premium zone. Whatever is below it is the discount zone. Now, in the premium zone, the first this thing we see is your rejection block, which is denoted by RB. Let me just put it there. The rejection block is the first one we see and is denoted by RB. The second one is the other block. The third one is the breaker block. And the third and the last one, last but not the least, is the fair value gap, which is denoted by FVG. right, now the same thing goes for this other ones again. Over here we have the FVG, we have the breaker block, we have the other block. All right, so what's on my screen right now is the PD array. All right, and these are the levels that your span guys are most likely positioned in the market. With the ones at the most extreme part being the strongest ones. Take for instance, breaker block, order block, rejection block tend to hold far more better than the fair value gap. The same thing here again, they tend to hold far more better than all these ones. Now, with this being said, there are two levels that um we want to focus on. All right, we don't want to focus on everything. And just so you know, there are more to this. There are more to this based on different concepts and all that. They have bring out a lot of them, variety of them. But we just need a particular level in the market that your smart money guys will be positioned. You don't need all of them. Even all these things, all these levels, you don't actually need them. All right. We just need to we're just trying to be more positioned and more refined. That's why we came up with all these levels. We are not supposed to be using all these levels normally to be taking trade. You just need to know that okay, smart money guys should be present in this particular level, then you can take your trade from there. But just so as to be precise and all that, that's why we tend to identify all these stuffs. All right. Now, if you are going to be using my model, which is the CCS model for advanced SMC, I only make use of the order block and the breaker block. Those are the two that I make use of. All right. So we'll be talking on each and every one of them here, down from the rejection block down to the fair value gap. We'll be talking on each and every one of them today, or perhaps some in this video and the ones in this video. So the first one we're talking about is the rejection block. What is the rejection block? Now, just like the name goes, rejection. Rejection is a particular level, like that particular word rejection. When it comes to the chart itself, or when it comes to the market, rejection basically means that price was rejected at that particular level before, at that place before. A rejection level is a level in the market that price have been rejected. That place have rejected price, and that's why we call it a rejection level. If you remember fully well, we made mention of this when we were discussing about market structure, that we talk about points of rejection. And those points of rejection gave us our highs and our lows in the market. Now, this one again is the rejection block. All right, this is the most extreme points of reversal that you most likely see in the market. In which, when price gets to this particular level, if price is to reverse, you not reverse for year, you not reverse for year, you not reverse for year. Then when it gets to this particular level, it will do what? It will most likely surely reverse from there. That is if price wants to reverse from that particular level. So it is the last, it is the stronghold of, should I say, of any high or of any low. The rejection block is the stronghold of them all. All right. Once price break above or break below a rejection block, it still means that price have disrespected that zone. That's where you most likely start seeing, based on our price, break out, you most likely see your market structure shift at that particular area, or you see your break of structure at that particular area, indicating information of a new trend or the continuation of the already known trend. All right. So rejection block that's just basically what rejection block is all about. Now, to identify rejection block, we make use of the words of wicks, the candle wicks of the higher time frame. Now, pay attention to this. Like I said, we make use of the word the candle wicks of the higher time frame. I did not say the lower time frame. I said the higher time frame. And in my case, I most likely tend to use, because this rejection block, like I told you guys earlier on, I don't use this rejection block that much. I don't use it. I make use of the other block and the breaker block. The only time most likely want to see me using rejection block is only in the higher time frame. And in my case, most likely the daily time frame, the weekly time frame, or the monthly time frame. That's where you will see me using rejection blocks. All right. Apart from that, in the lower time frame, you only see me using the breaker block and the other block. Now, the reason why I only make use of rejection block in the higher time frame is because inside of your rejection block, that's where you will see your lower time frame other block, breaker block, and all that. I've been using my DST for quite some time now, and I figured out that the ones that usually used to work perfectly fine is the other block and the breaker block, and that's why I've decided to do what? To stick with them. You don't need to know many things regarding the market. You just need to know the ones you can know, perfect it, and whenever they appear, you cash out wherever you want to cash out from the market. That's just it. So with that being said, let's head over to to go and work on all this stuff over there. And let me make use of this chart. I think I've used this chart in doing some little bit of explanation before. But regardless, I will just have to wipe it up. Let's Okay, let's just go with this. As for the reason why price don't reach that my points of interest above, we can all see it clearly. So now, how do we identify rejection block? We identify rejection block based on wicks of candles. Take for instance, you just need to take your rectangle and take it over to the wick of a particular candle, the wick of an eye, right, of the higher time frame. And with that, I've got to my what? I've got to my rejection block. So over here again, we also have another one. Remember, you just need a wick of the last candle, something like that. Now, remember, it doesn't have to also be the last candle. It can be any of the candles there, which we can also figure out soon. So, this is just how you can identify your what, your rejection blocks. In the case of an high, in the case of a low, the same thing. What am I saying here? I think price is reacting off the daily fair value gap one. This fat coin, well, after this class, I have business to do with this fat coin. If anybody dare go and let some fat coin because I get business to do there, me and I go fight. Rated off a fair value gap in the daily time frame. Rated off another fair value gap in the daily time frame. And now, rating off another fair value gap of the daily time frame. So, well, that's after class. So now let's check on a rejection block that price actually reacted to. Take for instance, we have one here. This rejection block that price reacted to do what? To do continue the market. You push to the downside. Not only that one, over here as well, you can see this rejection block here, the price actually reacted to. Okay, let me this candle that I use. And let me use this last candle. So see this one here. The one is myself. I most likely regard it as a rejection block, but we have this breakout that that price actually reacted from. This one was missed. So this is basically how we can identify rejection blocks in the markets. All right. just basically the wicks of um an high or a low of the higher time frame. Remember, of the higher time frame, not of the lower time frame. If you go and identify it from the lower time frame, it already put chaos for yourself. So let me see if I can get any other one. The crypto markets rejection block, how they work in this side, sure, because of their irregular pump and dump. Price can decide to dump from anywhere. Take for instance, I was expecting price to pull up to this particular rejection block. But what happened? Price used this one instead and dump further to the downside. Even went tonight to go and smash my FTP and all that. But that's for that. Let's check another this thing. Let me use EUR AUD. This one here. Notice that AUD is like sweeping off things. I have another one here. I have another one here. So I think this is enough already. So this is basically how you can identify rejection blocks in the market. All right. As you can see, all the ones that are identified are the ones that price actually reacted from, and they actually push price to its destination, like this one. If I was going to take this trade, place my this thing here, stop loss resting above. Sorry about that. This one, give me a 1:7 trade. Remember, you want to enter the market from your points of interest that you have identified, which is your component of market mechanics. That should be on it, all right? Not inside, not below it. It should be on it with your stop loss resting just below it in the case of long, and just above it, just like this one here in the case of a short position. That's in 1:10. Hope you see the reason why we always say that with your stop loss resting just above it. Because what happened here, you can see that price actually took it out or rejected. Oh, just a stop on. So, all right, this is just how you can identify your rejection block in the market and how you can use it. So, let's go over to talk about the other one. Now, the next one we're going to be talking about is the fair value gap. All right, the fair value gap will be the next one we'll be talking about. Then, for the other block and the breaker block, we talk about them during our next class. So now, what is a fair value gap? Now, a fair value gap is just a situation in the market, or rather, just a level in the market that price moved to one direction quickly. All right, price moved to one particular direction quickly, thereby leading to a gap at that particular spot. Normally, if you are walking down a step, you go slowly, slowly like that. Yeah, 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 yeah. All this thing. Yeah, 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 yeah. But if you go and use a step like this, ah, you go fall break it. You go fall break it. And this is you go fall break it if na this kind stay, then they go the waka on. All right. This is the type of stay that we can say that this stay is what is balanced. By this one, we see that this one is not balanced. The same thing with the fair value gap. When markets move too quickly to one direction, such a market is termed to be unbalanced, leading to imbalances in price, in which in such cases we term one side to be deficient, like that side were unable to they were not present. It was as if they were not present in the market at all. In a bullish fair value gap, we will say that the sellers were inefficient. They were like a bullish fair value gap, I think, is called the BISI, buy chart efficiency. Should I even forgot the name, but buy side efficiency, set side inefficiency of a thing. In which what that one actually means that your sellers were not in the market, just buyers dominating, and there cannot be buyers without sellers. That's why price will always come back and do what and fill up fair value gap in order to balance the market. All right. So that is the essence of knowing about fair value gap, to know when the market is actually imbalanced, to know if whether the market is actually going to return to that particular level again. Take for instance, now I use to identify my order block, and we also want to make sure that it have a fair value gap. Once you have a fair value gap, then we know that truly, truly price will come back and refill and fill up that fair value gap, tap into my other block and do what? And push to its normal direction. All right. So this is what you need to know about fair value gap. And then we were talking about how to identify the fair value gap. Now to identify the fair value gap, we make use of three consecutive candles. Now, it doesn't have to be candles of the same color. You just only want to see the gap. So you need three consecutive candles, and to identify the fair value gap, the wicks of the candle are very, very much important. Now, when you see a formation like this, in which this first candle, the wick, that means the eye of this first candle closes here. Now, this is the case for a bullish fair value gap, right? Now, when you see a candle in which the first candle, the eye was at this particular level, and the third candle, the low did not close up with this particular eye here, then in such case, we will say that there is a fair value gap at that particular spot. All right. Now, the second candle is the most important thing. All right. You want to make sure that the first candle, this thing did not enclose wherever. There's still a space in between the first candle high and the third candle low on the body of the second candle. I will come again. The space in between the first candle high, which is the weak high, all right, and the third candle low, the space in between them on the body of the second candle, that is what's regarded as the what? As the fair value gap. So with this is my fair value gap in this particular scenario. Now remember, the fair value gap don't have to be the same. That means the way it appears. All right. Take for instance, this can be a blue candle, red candle. This can be a red candle, blue candle, red candle, green candle. All right. So it does not have to be the same color. But when you see the one of the same color, it tends to hold far more stronger than the one of different color. Right? Then the one that have this one, let me say like now, in my case now, this one most likely be blue, then this one will be white, this other one will be white. That one is also a strong fair value gap. All right. Now there are different types of fair value gap. Like I said, I don't make use of fair value gap. You just need to identify it to know, like, because it's one of the criteria for picking out your order block. So I won't come here and be teaching you the different type of fair value gap we have. More or less, I'll just tell you what fair value gap actually stands for, which I've already did, and then tell you how to identify them, which I'm about to do. As for the different types of fair value gap, well, if you're interested to learn it, I think on the Telegram, there's actually a PDF talking about fair value gap there. All right. So with that being said, let's go and make some live samples or how to identify them on the live chat. Think this is the fat curiosity, and I've pretty much identified some of them already, but I'll just take it off and identify them again for you guys to understand it better. Now, this one is a 3 consecutive candle of the same color. So just like I said, you take your rectangle to the eye of the first candle, then to the low of the third candle on the body of the second candle, which is this one. So this is my fair value gap. And see this fair value gap over here as well. You have this here, and notice how price actually comes back to them. You have this here. This one is definitely not a strong fair value gap. But you see this one here? This one is a strong one, just like what I told you guys. I want to see when this candle is white, then the other one blue, in my case. And what happened? Price came back to it and reacted off that particular place. The same thing here. What happened? White, blue. Price came back to it and reacted off that particular fair value gap. When your fair value gap is with the trend, that's where it becomes more stronger. All right. And just the rejection block, it tends to hold far more better on the higher time frame. For those of you trading the Forex pairs, Charlie, when you come across ERO based pairs, then well, get ready because that particular pair, ERO based pair, they tend to look into like they tend to hold on daily time frame fair value gap. That's the secret behind them. You can go and make your research and you see it. So this is basically how you can identify fair value gaps in the market. You can see this one here, but it's too big. You have this one here as well. I think that's where price reacted from again before reacting to this rejection block here. This is a fair value gap here. So that's basically how you can identify your fair value gap in the market. I think this one, okay, price missed it. Probably in another this thing, it have already reacted from this particular area. But regardless, this is the fair value gap that we have here. Oh yeah, you can see this big fair value gap that price actually reacted to twice before pushing to the upside. Then while on that, price came back, pulled back to come and react from this fair value gap here, this one here, before actually pushing onward to the what to the upside again. And see this one as well. That's why price made this rejection. Then over here again, you can also see this little fair value gap here that price actually pulled back to before pushing to the upside. Still form another fair value gap, pulled back to fill out that fair value gap before pushing to the upside. Still gave us another fair value gap just like that. So you can see that price was just reacting from fair value gap at this particular point to do what to continue the trend. That's why I said that you want to make use of fair value gap when you are with the trend. And when you are with the trend, you make use of fair value gap. It will be a very sweet one for you. But regardless, should be on the higher time frame. If you go carry fair value gap, they use for the lower time frame. Sorry. Now your market go use the feed me after all. How they find liquidity. So here's another one, and you can see push price upward. Even came back from another fair value gap here, caused this reaction, this rejection, and you see that form that white candle. So that will be all on fair value gap. During the this will be all we'll be doing for this class in particular as well. Because of our next class, we will talk about the breaker block and the order block. All right. So, for any further this then, if you have any question, please, I'm all ears right now. Any question?
I have a question. Um,
Yeah, go on.
why, why is it that um, um, when you might see a fair value gap and let's say let's use 30 minutes time frame. You might see a fair value gap on 30 minutes time frame, or on a high time frame. You might not see it on that same place.
Um, Chief Mr. Emeka, I have to say, this your question was basically not a technical question at all because you can't expect to see something in the lower time frame and expect the same thing to be on the higher time frame. How is it possible? Like, how do you expect such a thing to be possible in the market? There are different time frame. You don't expect to see something you see in the lower time frame in another time frame to actually still see the same thing in another time frame. When such a thing happen, it most likely just a coincidence that such a thing happen. You cannot see something on one time frame and expect to see that the same thing on another time frame. All right.
Okay, sir. Thank you, sir.
Okay. Any other question?
I want to ask. I want to ask. whenever a market comes to a fair value gap, breaks the fair value gap, and also breaks the other block, what does that signify? Does it mean that it will continue going down, or it will let me just say a bearish trend, and it happens that it came to a fair value gap, and it
I
breaks the fair
understand
value
your
gap, and
question,
also
Chief Mr. Phantom. I understand your question
uh
already. And
yeah.
remember when what I said regarding the fair value gap, that it must be in accordance with the trend. Do you remember that? Huh?
Yes. Yeah.
A fair value gap. In fact, all market mechanics must be in accordance with the trend. That's why we treated market structure first. If your market mechanics is not in accordance with the trend, then have it in mind that your smart money guys won't be positioned in such level. That's why I told you guys that you know this level. That does not mean that they will hold every time. No, you just know
Okay.
them because
Okay.
based on research, these particular levels are the kind of levels like whenever smart money guys want to enter the market, you most likely find their position around all these levels. That does not mean that they make use of all these levels to enter the market. Have this in mind first of all before you go enter market. So always have it
Okay.
in mind that even if you see one particular destiny, that does not mean that that place will hold 100%. That's why we tend to make use of other things,
Okay.
combine them together to do it, so that our place that we want to use, we have a credibility, we have a stronger stand. And one of the factors that we use is following the trend. That's why we treated market structure first. If you are trading against the trend, just to say everything will fail, demand zone, daily
Okay.
time frame demand zone go fail, 4 hour demand zone go fail, 4 hour that block go fail, fair value gap, all of them go fail because why? They are trading against the trend. That
Okay.
is one of the number one criteria I want to look into. That is why if we move over to if we go deeper into the criteria for all these market mechanics, you will see there that boldly that you want to see your break of structure first or your market structure shift to know that yes,
Okay.
you are trading with the trend. But peradventure
Okay.
trend does change. That's where you will see your fair value gap not holding. Price go do wetin go still go break the other block, break the rejection block, and give you a what? A market structure shift to the downside or a break of structure to the downside. That one should tell you that it was because you are trading against the trend. That was why all those market mechanics not do wetin they not hold. Does that answer your question?
Okay. Yes.
All
Thank
right.
you.
Anyone have any other question before we call it a day?
Yeah.
Please,
Hello. So sorry.
the videos we made available today.
You said?
Please, I would like to rewatch the video. Would it be made available today?
Whenever it's available, I will let you guys know. I think we have done four
Okay.
classes now, and one of the videos is available. So just like that, I will keep on making the other ones available. So just relax for now. So who else have any other question regarding the class?
Yes. I also want to ask, when it comes to a rejection block, is it only on daily time frame and other higher time frame, like 1 hour, 4 hours, daily, weekly?
I
Is
made
that the
I made
basis that we
a
can
I made a
identify?
clear point. I made a clear point when it comes to the rejection block, and I said only make use of rejection block in the higher time frame. Now, not just in the higher time frame, the higher of the higher time frame, the extreme higher time frame. That was why I went to the daily time frame to identify rejection blocks for you guys. You see me say I make use of 1 hour time frame? No, 1 hour time frame is more or less if I should define 1 hour time frame for you, to me it's more or less an intermediary between the higher time frame and the lower time frame. Anything below 1 hour time frame is a lower time frame, be it the 30 minutes and all that. To me, I don't know for you, I don't know what you want to trade, I don't know which time you want to be working on. But for me, anything below the 1 hour time frame is a lower time frame. 30 minutes, 15 minutes, 45 minutes, 5 minutes, 3 minutes. All those ones, I regard them as lower time frame. They are the minute time frame than not the hourly time frame. Now, when it comes to the hourly time frame, the 1 hour time frame, like I said, I use it more or less as an intermediary between the 4 hour or 3 hour time frame and the lower time frames then. So before we descend from the 4 hour time frame to the 15-minute time frame, the 1 hour time frame, I will first of all check it to confirm everything that I've seen on the 4 hour time frame or the 3 hour time frame or the daily time frame before moving down to my trading time frame, which is most likely the 15-minute time frame.
Okay. That's fine. I'll forget you. Thank
All
you.
right. So anyone have another question before we call it a day? Okay, absence of no question. That will be all for today's class. We meet tomorrow for the next
Sir
class.
Clinton,
Remember,
Sir
yeah,
Clinton,
yeah, I
I
can hear
wanted
you.
to ask, okay, it's about structures, sir. It's about structures. I wanted to ask is, what's your total so far based on market structure and everything? Is applicable in all time frames so that
Wait a minute, wait a minute. I didn't make any mention of market structure. This is market mechanics. If you have a question regarding market structure, you should ask it when you should have asked when we're discussing about market structure. And since you not ask at that time, then on the WhatsApp, you ask me that question. All right. This class
okay,
is
okay.
basically for complex market mechanics. And we're done with that one. I don't think any one of you have any question regarding that. So this will be the end of today's class. Good night, everyone.
Okay.